Hello, and welcome to today's episode of the Macrocast. I'm your host, Ylan, a managing director at Penta. And today we're a small but mighty team. Brendan Walsh of Markets Policy Partners is my co-host. Our friend John Fagan is off the grid and on vacation today. But we've still got a lot to talk about, including the latest inflation data in the U.S., deflation in China, and the potential for more tremors in the banking system. So, Brendan, I think that John's going to be pretty jealous that he missed our conversation today, don't you?
Exactly. Very exciting topics.
Absolutely. So let's go ahead and just dive right on it. We've been getting some conflicting signals on inflation here in the U.S. We just saw a negative reaction in the markets to the latest data on the producer price index. The Labor Department reported that producer prices rose 0.3% from June to July. That's the highest monthly increase since January. A lot of that was driven by the services sector, up 0.5% on a month-over-month basis. But when we saw consumer price numbers, they were actually below what economists had forecast them to be. So it seems like there's still a lot of mixed data coming out.
So the CPI was a little below expectations, especially the core. But the PPI, which came out today, was a little above expectations. And as you said, it was driven by services. But it was a little kind of weird. Portfolio management services were up 7.6%, which is just kind of weird. So if you back that out, and it would have come in line with expectations. So I don't think we want to overreact to this PPI number because it was one just kind of weird data point. But as a slight caveat, the PCE price index is what the Fed targets, and 80% of that comes directly from the CPI and the PPI. And what they take from the PPI is a lot of the services. So the healthcare services were up a little bit in this PPI, and this brokerage is one of the inputs. So there is a little risk that the PCE price index comes in a little higher than people would have thought yesterday. But again, going back, you don't necessarily want to make huge financial decisions or monetary policy based because one weird component was up a lot in 1 month.
Yeah, I saw that portfolio management component in the PPI, and I thought, just another reason to blame Wall Street, right, for inflation.
Exactly.
It all comes back to Wall Street, right? But I think that's a good point because there's so many different ways to slice and dice the inflation data, not just PPI, not just CPI, not just PCE, but we have another term of art now coming into play, which is this idea of super core inflation. So if you think about core inflation as the consumer price index minus the volatile sectors of food and energy, now folks are talking about super core as really the index to measure because that also backs out housing, which has been one of the sticky points, I guess, when we think about inflation, housing prices, still remaining high despite mortgage rates going up. And even in the CPI report that came out over the past week, 90% of the increase in the CPI was due to shelter costs.
Exactly. But also, so the supercar is a really important point, but I think it's kind of dangerous because, as you said, 90% of the increase in this last CPI was housing, but also a huge reason that the inflation went up so much in 2022 and why the Fed, was behind the curve was because of the housing components lag. Now we know that, because we have real-time data, from Zillow and Redfin, that this is going to drop precipitously. There was a San Francisco Fed study that shows that those numbers are probably going to be negative in early 2024. So if we paid attention to it a year ago, why now when we know what's coming and we're going to probably be in deflation in terms of the core component in, sometime in 2024, why are we now just ignoring the housing, component? The issue is just the way they pundit is incredibly lagged.
Yeah, that's interesting because I feel like, well, so a couple of things here. One, one thing I guess working in favor of the data is that starting in this month, really, you start to see a change in the base effects, right? So it was July 2022 when we started to see inflation begin to moderate. So you're working off of a different baseline, which could help the data a little bit, but also, I don't know. I guess I've just been confused because I feel like, we all believe and think that no way can housing prices remain this high, even as we see, mortgage rates, remain at, what is it now? 6% plus?
Yeah, exactly.
Somewhere around there, right? I haven't looked because I'm one of those people who's locked in and not moving at a low rate, right?
Yeah, but 80% of mortgages are locked in at long-term rates.
Yeah, so I guess my point is, the data that we see from like the National Association of Realtors, et cetera, shows that, housing prices are still at, historically high levels. Mortgage rates are still high, but we all are saying it can't stay this way, but it has. So I'm not sure what the turn is going to be. If there's going to be an unlock in supply, is it going to be that the home builders are finally going to sort of catch up a little bit so that new home sales will be able to take off and increase that inventory? I'm not sure what the turning point is going to be.
It's a weird dynamic because, as you say, the house prices have rebounded and stayed high, but volumes are at all-time lows. There's not many houses on the market, and also very few are actually being built also. So ironically, lower rates might bring down the cost of houses because more houses would come on the market.
Because people will be more willing to move, right?
People would be willing to move. Yeah.
There's all kinds of counterintuitive dynamics going on.
Yeah, we're in a very weird this time really is different. We went through a pandemic and weird things happened, and now we're kind of coming out of it and figuring out how to how things work. So it is a very difficult time to be a central banker.
What do you, if you say that housing prices though are going to eventually come down in 2024 and potentially lead us into deflation just because of the the basis of change, right?
Yeah, so that already happened. That happened in the last 9 months. But now what we're seeing is housing prices stabilizing and going up a little bit. But because the way that the BLS computes the housing component, it's with basically a 12-month lag. So we already know exactly what's coming into these numbers in the next 12 months, and they're going to drop a lot. Yeah. But that doesn't have anything to do with what's going on today in August of 2023. Yeah.
Got it. Well, I guess to your point, we see the two different directions in terms of the inflation data, and we're also hearing different directions coming out of Fed officials during, all the various comments that they've made this week. We've got folks like Patrick Harker saying pretty explicitly that the Fed can be patient and hold rates steady. But meanwhile, you have folks like Fed Governor Michelle Bowman saying that the Fed is probably going to have to raise rates even more in order to have that credibility around their 2% inflation target.
Yeah, and even San Francisco Fed Daily, who is kind of known a little more of a dove, said, we're not done on the inflation fight. So the market is now pricing in, I believe it's about 85% chance that they hold in September. And that's what John and I think that the Fed is done. But where we disagree with what the market is pricing in, the market in the back half of the year in 2023, but also in 2024, is starting to price in rate cuts. And we think the Fed, that's where they're going to make their stand. They're going to pause, but they're going to be the bar to cut rates is going to be much, much higher.
Yeah, and you guys, I feel like we're pretty early in that prediction, right? I mean, I think the Fed snuck in maybe one more rate hike than you guys were expecting, but essentially saying that the Fed is near its terminal rate, right? And that it's gonna stay there and hold there despite a lot of pressures to cut. And that's really where sort of the backbone is going to need to be shown, right? It's not necessarily, they've already shown that they're willing to hike aggressively. The question is, how long are they really willing to hold it, especially if you see inflation coming down, which means that, right, the real rates, right, the sort of real impact of monetary policy is even tighter.
Yeah. And this week we did see some cracks in the labor market. So The initial unemployment claims were much higher. They're almost 250,000, which is still historically fairly low levels. But it's a sign that people are starting to lay off. But ZipRecruiter had to pull their guidance because they saw such a massive drop in companies posting online job postings. So that's a bit of a canary in the coal mine. That there was basically an unprecedented event in their existence. How quickly their customers stopped posting new job hirings.
Yeah, that's really interesting, and I wonder if that's kind of an explanation for what we've been seeing in terms of the labor market, right? Is that if we see job openings maybe taper off, we won't see the massive, layoffs or the massive shedding of jobs that folks have been fearing. Is there a way that we can cool the labor market by reducing new hiring without resorting to firings?
Yeah, that's the Goldilocks scenario. And actually, that seems to be what was playing out as now. You're not seeing huge, layoffs, but you're seeing definitely a slowing in the hiring. But as long as Taylor Swift keeps adding tour dates, I think the overall GDP is going to be all right.
I was hoping that we would find a way to work in the second leg of the Eras tour in 2024. I got to say, this is a. There's the macro, we're the Macrocast, but there's micro moments as well, Brendan, which is how much am I actually willing to pay on the secondary market for Taylor Swift tickets, because I did not get a code to buy them on the front end tour. But truthfully, actually, this actually crossed my mind this morning, Brendan, as I was getting ready and thinking about the Macrocast, which is maybe if we go into a mild recession early next year, that'll bring down the cost of Taylor Swift tickets. And maybe that's the moment for me to strike. I don't know if that's really going to be the case. Maybe that's my Goldilocks scenario. Right. But still, certainly consumers have been resilient throughout this process, as evidenced by Taylor Swift, as evidenced by Beyonce's tour, and as evidenced by the numbers that we're seeing in terms of retail sales, which we'll get an updated reading next week. But despite the drawdown in fiscal stimulus, despite the drawdown in savings, folks are still spending. Maybe that's going to come back to bite us later on. I think I saw.
Yeah, credit card balances are increasing, not like horrifying levels, but we are at all time high. But obviously the economy grows, so we're almost always at all time high levels. But the consumer is putting more on the credit card than they have in the last 2 years.
Yeah, absolutely. So maybe that debt overhang is going to become a challenge later on. But for right now, consumers, people have jobs, people are still willing to spend, and that's offering that floor of support for the economy. I did want to talk to you a little bit about what's going on in China, because it seems to be maybe the opposite of what's happening here in the U.S.
They had outright deflation in the latest CPI report.
Yeah, and it seems like one of the big drivers of that, well, there's a couple of drivers of that, obviously, is that their post-pandemic recovery has not really been a post-pandemic recovery. And there's some interesting long-term questions about how much of that is a change in consumer behavior, consumer mentality, because people were shut down for so long. We talked about how the consumer is supporting the economy here in the U.S. There's been some interesting commentary from Adam Posen over at the Peterson Institute around this idea of economic long COVID and how the impacts can draw out over an extended period of time, in part because consumer mentality was changed so much in China. Right. So that's one piece of it. The other piece of it is just, Chinese debt. I mean, I was shocked to see one estimate from JP Morgan that China's debt to GDP ratio is bigger than that of the U.S., 282% of GDP. I mean, that's crazy.
Yeah. And so much of that is in the property sector, which when things would slow down, that's what they'd use to stimulate the economy. But they can't do it this time because, you have so many losses that they're on the bank's balance sheets, but they have it, written them down yet. So it's very difficult for the Chinese economy the government to stimulate. So today we actually got new loan data, and it was the lowest since 2009. So and that's what the government's been using to kind of backdoor stimulate the economy is through the banking sector. But it's not working now. They have a meeting on Sunday, on their loan prime rate, which is their equivalent of the Fed funds rate. And there's a lot of expectations that they'll continue to cut.
Brendan, do you think if China stumbles, does that drag down the U.S. and the global economy? Or does that provide support for the U.S. economy because Chinese exports are cheaper?
Yeah, I think China's a little less important than it was, especially coming out of the great financial crisis. But it's not good for the world. They still, produce a lot, but also they've become a consumer economy. I think it's not the end of the world for the United States. A recession in China probably means lower oil prices, which is good for us. And also, as you said, we still buy a lot from them. So goods, you'll see even more goods deflation. So I think the United States can survive it, but global growth will slow.
Yeah, and there's also related to China's debt to GDP ratio and just China's massive debt is China's massive lending, especially to underdeveloped countries, and the impact that their unwillingness to perhaps change the terms of some of those loans because they need the cash back at home.
No, I know. So
right?
This is a great opportunity for the United States, but also the global economy and the World Bank and the IMFs to, China really went aggressively with the Belt and Road and made loans. And a lot of those borrowers are regretting the experience. And especially you said, like, you're not allowed to rework any of these loans. So this is a great opportunity from a geopolitical perspective for the world to, kind of go back into those areas of the world that China, made a lot, and maybe try to help them out and produce some goodwill for us and try to take a lot of that influence away from China.
Maybe undo some of that checkbook diplomacy that went on.
Exactly. Yeah.
Well, this is a good point, I think, to take a quick break. When we come back, we're going to talk about some of the new warning signs in the banking sector and some more about what's happening in commercial real estate. Stay tuned.
Penta is the world's first comprehensive stakeholder solutions firm. We are a one-stop shop for the intelligence and strategy leaders need to assess a company's reputation and make decisions that improve their positioning. As executives in the C-suite must account for a growing set of engaged stakeholders, all with distinct, fast-changing demands, Penta provides real-time intelligence and strategy solutions. We work with clients solving complex global challenges across a variety of industries. Our clients span technology, financial services, energy, healthcare, and more. To learn more about how Penta can support your company, check out our website at pentagroup.co, our Twitter at PentaGRP, or find us on LinkedIn at Penta Group.
And we're back with the Macrocast. The turmoil in the regional banking sector may not be over. Moody's has downgraded 10 mid-sized banks, citing high funding costs, deteriorating asset quality, and the potential for a decline in commercial real estate. Now, some bigger banks were also put under review, including Bank of New York Mellon, U.S. Bancorp, State Street, and Truist. Brendan, is this what you've been worried about all along? Is the chicken coming home to roost? Is that the right term of art?
Exactly. We last week we talked about Fitch downgrading the U.S. to not AAA, which we kind of agreed that was silly. It didn't really make sense. But this downgrade makes a lot of sense. It's based in reality and just kind of economic. The economics of being a regional bank is very difficult now. So just immediate, they still have a huge amount of funding problems. It's hard to keep deposits, so that they're having to pay up. So, but that's not a end of the world thing, but it's definitely a profitability. But what is also troubling is when we went through the Silicon Valley, the Fed created the Bank Term Funding deposit. What's it called? Let me get the actual name of it.
Bank BT.
The Bank Term Funding Program. Yeah.
Okay.
And so that's where, all of them bought treasuries that are now worth less. So you're able to put those to the Fed and get, full 100% credit. All of these banks are still massively using this, and it is set to run out in early to mid 2024, and there's no plans to replace it. So that's a problem, because I'm not sure that rates are going to massively. We don't expect the Fed to cut, so those treasuries are still going to be underwater. So you have the funding issue, you have the mismatch in terms of your treasuries, which are supposed to be safe. And now as you said, you throw on it the issues in the commercial real estate sector, which we've talked about a lot. And it is a slow moving, kind of train wreck, but it's coming. And as we know, it's the regional banks and small banks are the ones that make these loans. The big banks aren't really hugely involved in that.
Yeah, I think it's notable that we're starting to see some pushback around this idea of the CRE train wreck from the banking sector. I think that they saw the downgrades. They hear the Fed talking about this, and they're trying to insulate themselves, perhaps from certain criticism. The American Bankers Association released some data showing that the top 25 banks hold 46% of all CRE loans. So that's a lot. But,
yep.
Their argument here is that those loans only account for a small percentage of their assets, 4.3%. So while they do hold almost half of CRE loans, it's not a big part of their portfolio, and that's one of their.
Yeah.
So therefore, the argument there is therefore the risk is it's not necessarily systemic, and it's not, and it's relatively dispersed.
Yeah, and I agree with that. But also that's kind of what Moody's is saying too. They're not saying, this is the end of the world, but they kind of put them on negative watch, which is, what a rating agency is supposed to do. They put some red flags up, and it is a little different. So they're not talking about what the stock price should be. Moody's is about the debt of these companies. And, if losses are coming, a borrower should be aware of that.
What do you think is the ability of some of these properties to convert to other uses, right? So we've talked a lot about the challenge of the downtown office building and what do you do with it? If are workers eventually going to come back, or do you just call it a day and try to revamp the property into something else?
Yeah. So the big buildings downtown, those are difficult to convert into residential. But that's not all of what commercial real estate is. A lot of commercial real estate is, the strip malls, and things like that. Those are easier to convert because honestly, it's easier just to knock it down and start over again. But also you can convert it into something else. So it's not that every property is complete disaster. The issue is that those downtown, B properties, especially the ones that are newer. Older buildings are easier to convert into residential because of the air conditioning, and they don't have the open concept floors. The whole problem of converting has to do with plumbing and then air conditioning. So it is difficult to convert a relative, something built in the last 20 years to residential. Those, I'm not sure what's going to happen to a 25-story downtown office in DC that can't be converted into residential housing.
Yeah, well, I wonder if let's think far ahead now, but there's an effort by President Biden to bring the federal workforce back into the office.
That's an important point. Yeah, we need our leaders to say, go back to the office. And the easiest way to do it is the federal government. We're allowed to say you have to be in the office, Right.
I mean, here in DC, that's kind of what, we're focused on. But I wonder if there's a day when, the owners of the commercial properties have sort of given up and started converting to other uses or found other tenants, et cetera. business owners are saying, come back into the office. And all of a sudden now there's nowhere to put them because all the office space is
we could overact the other way. I agree.
Converted to something else. Yeah.
And this is a hard one because it's not just economic fundamentals. It's not, oh, here's the cap rate and it's viable. We changed our behavior and we're not exactly sure if we're going to go back to the way we used to behave. So it's just very difficult. I don't think anyone knows the answer because it's coming out of a pandemic and people decided we don't like to go to the office, Right.
Well, another little micro piece of data, but over by our office, which had become somewhat of a wasteland in terms of coffee shops and sandwich shops, et cetera. Blue Bottle opening back up
oh, that's
by
a good
our
sign.
office, which I'm very excited about as well, because they're
that's a very good sign.
Yeah, they're one of the few coffee shops that actually makes a New Orleans chicory cold brew. So I'm waiting for that day with bated breath. Absolutely.
Our office is right next to the White House. We're prime location, and we were a wasteland for a while.
Yeah. Well, if President Biden is successful in getting those workers back, maybe there'll be not just Blue Bottle,
but a federal government job is one you can do. Like someone's not going to quit and lose their pension because they don't want to come to the office. Private sectors, but if the federal government can lead the way, then I think the private sector can follow. This is DC, which is a unique place that doesn't, affect Boston or whatever, San Francisco. But DC actually can bring a lot of people back to the work.
And, and it's not just in the city. I mean, federal agencies are scattered all across in the suburbs as well. That could have an impact on those strip malls that you were talking about as well.
Yep.
So, well, we will see. For now, that is what we have to talk about in terms of what we saw over the past week, but there's a couple of interesting things happening in the week and a couple of weeks ahead, including the Jackson Hole Summit coming up.
Yeah, very exciting. So I know they had reduced the amount of reporters that were allowed to go a few years ago. Is it kind of back open to everybody?
Yeah, I don't know. I mean, the way that they had done when I was covering it, which is obviously well before the pandemic, was one reporter from each major outlet was allowed to attend, and then additional reporters could attend, but they couldn't go into the actual conference sessions.
Oh, okay.
You could basically sit outside and network and buttonhole Fed officials as they walked in and out, and
go on hikes with them.
Go on hikes. You could still do. What is it? Don Cohn's Death March, I guess, is what.
Yeah, I've heard about that. Yeah.
So that was still an option. I never did it, but those who are so inclined could.
Yeah.
But I'm not sure what the policy is now. But it'll be interesting to see whether or not Chair Powell uses the moment to signal any change in director or shift in the winds for Fed policy.
Right, because he left us saying we're data dependent, and I don't think we've got enough data in between. When he spoke, 2 weeks ago, and in 2 weeks from now, to massively change that. But if you were going to give a signal that we're going to be on pause for a while, Jackson Hole is obviously the perfect place to do it.
Absolutely. All right, Brendan. Well, that is it for us today. I'm Ylan Moy with Penta. Brendan from Markets Policy Partners was in the driver's seat with me. We hope you enjoyed our show. And please remember to like and subscribe to the Macrocast wherever you get your podcasts. Thank you so much for listening.